Carol opened the envelope on a Tuesday morning in January. She had been expecting it, her first Medicare premium notice, the thing she had planned around for years. She knew the number, $202.90 a month. She had written it into her retirement budget in ink. The number on the page was $405.80. No explanation, no warning letter, no phone call from anyone, just a bill for more than double what she had prepared for, deducted automatically from the Social Security check she had not even received yet. Carol is 66, former mid-level operations manager, 31 years of diligent saving, careful planning, and exactly one catastrophic blind spot: a Medicare surcharge that roughly 6 to 7 million Americans pay every year, and that almost none of them see coming until the bill is already in their hands. Here's what nobody told her. Medicare doesn't charge everyone the same premium. If your income exceeds certain thresholds, you pay more, sometimes 2, 3, even 4 times the standard rate. The surcharge is called IRMAA, and it's calculated using income from 2 years ago, income Carol no longer earns from a job she no longer has. That's the first thing that should make you angry. The second thing, there may be a way to fight it, but the window is narrow, the process is obscure, and the system is not designed to help you find it. Between 7 and 10% of all Medicare beneficiaries pay this surcharge. Most of them discovered it exactly the way Carol did, not from a financial advisor, not from Medicare itself, from an envelope. The surcharge has a name that works hard to sound harmless: the Income-Related Monthly Adjustment Amount, IRMAA. It sounds almost friendly, like a helpful aunt who handles the paperwork. What it actually is: an additional premium layered on top of your standard Medicare Part B and Part D costs, triggered the moment your income crosses a threshold, collected silently, and almost never explained in advance. IRMAA applies to Part B, your outpatient coverage, doctor visits, and preventive care, and to Part D, your prescription drug plan. It is not a penalty in the technical sense. Medicare calls it an adjustment, which is doing considerable work to make a punishing extra charge sound neutral and administrative. Here's the mechanical detail that trips people up most. The income Medicare uses is not your taxable income. It is your modified adjusted gross income, MAGI, which is line 11 of your federal tax return, your AGI, plus line 2A, tax-exempt interest income. That second line is where municipal bond income lives, income that most investors assume is invisible to the government because it isn't taxed. It isn't invisible. It counts in full toward your IRMAA calculation. That is a quiet trap inside the larger trap, and it gets worse when you see the numbers. IRMAA doesn't work like a tax bracket where only the income above the threshold gets taxed at the higher rate. It works like a cliff. You either fall or you don't. And if you fall the entire way. For 2026, the standard Part B premium is $202.90 per month. That applies to single filers at or below $109,000 in modified adjusted gross income, or married filing jointly at or below $218,000. Cross the first threshold, $109,001 for single filers, and your premium jumps to $284.10 per month, plus $14.50 in monthly Part D surcharges. That's Tier 1. Tier 2 runs from $137,001 to $171,000 for single filers. Premium, $405.80 per month, plus $37.50 in Part D surcharges. Tier 3, $171,001 to $205,000, $527.50 per month, plus $60.40 in Part D surcharges. Tier 4, $205,001 to $499,999, $649.20 per month, plus $83.30 in Part D surcharges. Tier 5, $500,000 and above, $689.90 per month, plus $91 in Part D surcharges. For a couple at Tier 5, that's $578 per month in IRMAA surcharges alone. $6,936 per person annually, $13,872 for the couple every year, just in surcharges. Now here is where the cliff structure becomes genuinely brutal. A married couple at $274,000 in modified adjusted gross income sits in Tier 1. They pay $81.20 per person per month above the standard premium, $1 more, $274,001, and they fall to Tier 2. The extra cost of that single dollar is $2,901.60 per year combined. Stop and sit with that for a moment. $1 of additional income, nearly $3,000 in additional cost. This is not a marginal system. It is a binary trap at every threshold, and the thresholds do not announce themselves. The mechanism that makes all of this so disorienting for new retirees is the lookback. Your 2026 Medicare premiums are calculated using your 2024 modified adjusted gross income, the income reported on the tax return you filed in early 2025. Social Security receives that data from the IRS and applies it automatically. The 2-year lag is structural, built into how the administrative system functions. But for someone transitioning from work to retirement, it operates like a time bomb. Bring Carol back into the room. In 2024, she was still working. Her final full year of employment pushed her modified adjusted gross income to $155,000, solidly in Tier 2 territory. She retired in December 2024. In 2025, her income fell sharply. Social Security, modest portfolio withdrawals, maybe $60,000 total. But in 2026, Medicare does not see 2025. It sees 2024. Carol's first full year on Medicare is priced at $405.80 a month, based on income from a job she no longer holds, in a life she no longer lives. And the time bomb resets every year with a 2-year delay. There is a second detonator that catches retirees who thought they had planned carefully. At age 73, required minimum distributions from traditional IRA and 401k accounts become mandatory. For retirees who spent decades building pre-tax savings, required minimum distributions can be substantial, large enough to push modified adjusted gross income, MAGI, over an IRMAA threshold, even when actual spending is modest. A retiree living comfortably on $55,000 a year can find themselves paying Tier 2 or Tier 3 premiums because a $120,000 required minimum distribution landed on top of their Social Security income. The account balance they built for security becomes the instrument of the surcharge. Does that feel like the system working as intended? For millions of retirees, it feels like a trap they built themselves, one careful contribution is at a time. Now for the part Carol did not know existed until a friend mentioned it 3 months after the envelope arrived. There is an appeal process. It requires a form called SSA 44. The rule is specific. You cannot file before you receive the IRMAA determination notice. Once you have it, you can request a review, but only if your income changed due to one of 8 qualifying life-changing events. The list is precise: marriage, divorce or annulment, death of a spouse, work stoppage, work reduction, loss of income producing property through no fault of your own, loss of pension income, receipt of an employer settlement payment. Carol's retirement qualifies as work stoppage. She can file SSA 44, attach documentation of her retirement date, provide a projection of her current year income, and request that Social Security use a more recent tax year rather than the 2-year lookback. If approved, her premium adjusts downward, potentially to the standard rate. One mechanism worth knowing: the same qualifying life event can support appeals across 2 consecutive determination years. Carol's December 2024 retirement could potentially justify adjustments in both 2026 and 2027, buying her 2 years of lower premiums while her income history catches up to her actual life. One critical exclusion: a Roth conversion is not a qualifying event. If your IRMAA surcharge was triggered because you converted pre-tax IRA funds to Roth, even strategically, even at your advisor's recommendation, you cannot appeal it. The surcharge stands. That surprises almost everyone who hears it for the first time, which brings the conversation to the strategies that actually move the needle, the ones Carol wishes someone had explained at 63. Retirement timing matters more than most people realize. Retiring early in a calendar year rather than late reduces your final high-income year's MAGI, which determines your Medicare premiums 2 years later. A December retirement versus a January retirement can mean one additional full year of employment income in the look-back window. That single calendar decision can cost or save thousands. Roth conversion laddering in the years before Medicare eligibility, roughly 60 to 63, can significantly reduce future MAGI that is driven by required minimum distributions. The trade-off is real. Conversions raise current year income, which can itself trigger IRMAA. The math requires precision, not guesswork, but the long-term reduction in required minimum distribution exposure can be worth it. And MAGI awareness in the 2 years before Medicare begins is essential. Investment decisions made at 63 or 64, selling appreciated property, harvesting capital gains, or exercising stock options set your first Medicare premiums. The municipal bond reminder applies here too. Tax-exempt interest is not exempt from IRMAA. It counts fully every time. The reason IRMAA catches people off guard is not complexity. It is silence. Financial advisors focused on accumulation do not always pivot to Medicare mechanics. Tax preparers file your return without flagging that this year's number will determine your Medicare premium in 2 years. Medicare itself sends no advance warning. Insurance agents have no incentive to explain a cost that is not part of their product. The system is not broken. It is working exactly as designed, quietly, at a 2-year remove, collecting surcharges from people who did not know the rule existed. Carol filed her SSA 44. Her premium was adjusted, but she had already paid months of overcharges, and she spent those months convinced she had made some mistake in her retirement planning. She had not made a mistake. She simply had not been told. Think about that. 31 years of careful planning, every contribution maximized, every budget line reviewed, and the thing that blindsided her was not a market crash or a health crisis. It was a form she did not know existed, triggered by a rule nobody mentioned, calculated from income she no longer earned. Carol's envelope arrived on a Tuesday in January. Yours might too, unless you know what is inside before it gets there. That is the thing about a system built on what you do not know. It does not need to hide. It just needs to stay quiet long enough for the money to move. This channel provides general educational information only. It is not tax, legal, medical, or financial advice. We are not affiliated with any insurance company, the Centers for Medicare and Medicaid Services, or any government agency. For decisions specific to your situation, consult a qualified professional who knows your full picture.